close to the 6 to 7 months, y'all, in most markets. So that's what would have to happen. We would have to be way up into the gray area of that graph, where we would be way into a buyer's market, like 9, 10, 12 months of inventory to see a crash. Okay. Now, there are some ways, if you're a seller and you're watching this, there are some ways, if you're in that spot where your house is just not selling, I have a couple of tips. I'm sure your realtors are giving you tips, or you might be going at it on your own, but these are the reasons we usually see. I've got 29 years of experience. These are some reasons why we see things are not selling. It's not priced right. It's cluttered. It just doesn't stage right. There's just lots of stuff. People can't imagine seeing their things in your house because there's just too much visually in the way. And the other thing, you might not be using a realtor. Now, realtors serve a really, really viable purpose. You want to check out my YouTube channel, Loan with Jen. I've got a video actually about realtors and what they do. What do they even do, right? Should you use a realtor? Actually, the video is called Should You Use a Realtor? So I'll put it down in the description below. So let's talk about what markets are actually soft right now. So I've got this interactive map. This is actually a link that you're definitely going to want. If you're watching me on a platform that does not allow links, there's a couple of them. Just DM me if you want me to send you the link, DM or comment and say, hey, I want that link of that interactive map. So here is the map right now. The blue, really the red and the orange areas are the ones where the markets are actually softening, meaning the days of and months of inventory is increasing. Florida, the Gulf states, you can see it right there on the Gulf of Mexico, just kind of right on the coastal areas. They're cooling off a little bit, but it's interesting that it's really not rampant at all. You can actually see a lot of the blue areas. That is where things are still pretty, what we call tight, where we've got maybe 1.5 to 2.5 months of inventory. So it's super interesting. Now, in my hometown of Houston, Texas, I did the interactive map and I clicked on mine. We're still at like 40 days, 1.5 months of inventory. So it's quite interesting. So I'll send you this link. Now we've got some questions, so I wanted to go ahead and answer those. So I appreciate y'all asking. Okay, Mary Nicole, we're supposedly at 4.5 months right now. I think it's stagnant because of rates and issues with nature we've been having. Prices jumped so high a couple years ago. Yes, you are exactly right. I'm assuming that you might live in Houston because we had a storm, we had a hurricane. So we have seen things temporarily slow down a little bit, but I do still see some good activity. And like I said, Mary, you might be in one of those areas that there are a few additional months of inventory. But do remember, I know 4 to 5 months from what we've experienced in the last few years, 4 to 5 months seems like a lifetime to buy your house, to sell your house. But it's actually still a pretty balanced market. Just talk to your realtor about things you can do. Maybe you can offer the buyer some closing costs. I think a lot of people need closing costs right now. So if your house is sitting on the market and you're wondering, like, what can I do to move it? You want to offer some closing costs so that buyer can buy down their interest rate. That might bring some more traction. But thank you for the question. I've got another one here. There's many homes with price drops, but I don't see prices decreasing annually at all. Yeah, price drops, that's a great question. Prices can drop because many reasons, but you could have a seller that just prices it unrealistically. So pricing drops don't necessarily mean that the market is, caving. If you've got sellers that don't start at the right price to begin with, that's when you might see some sales reductions. So again, it goes to the psychology and the mentality of who the seller is. Are they just throwing numbers out there, seeing what they can get? I've known some sellers that have done that, and It's not 2021 anymore where people were getting these overinflated prices that they wanted. Buyers are not going to overpay because the rates are so high. I think what I see is things going, at least in my market in Texas, I see things going for fair market value, which I think is fair. Fair market value is fair. And the houses that do have extra days on the market, I'm seeing some seller credits, which is good. They're able to buy down their interest rate. Let's see if I got any more comments. Nope. All right, but let me hear your questions. I'd love to have them. Okay. So I'm looking at my outline here. Oh, I know what you're thinking. You're like, Jen, what about the foreclosures? I know a few people actually love them dearly, but I don't agree with them that foreclosures are just going to take over the market. Foreclosures happen for sure. And foreclosures are needed for any healthy, it's healthy in the market for foreclosures to happen. And we actually need investors usually gobble up the foreclosures before they make it to the MLS, by the way. Foreclosures are just a part of life. There are people that just cannot make the payments. I super agree. But right now, with the tight market, if you're pending foreclosure on your house, you're going to sell it. In fact, I'll tell you a quick story. Just 2 months ago, we had a buyer. The seller did not tell anybody that they were almost going to be in foreclosure. Well, we were almost to closing. We were literally like a week from closing, and the guy could not close because his payoffs were more than the sale price. So it stalled out, canceled out. A month and a half later, my buyer is now back under contract for the same house, but the bank owns it. The bank is the seller. So it was in foreclosure like as we were talking, and the seller just didn't tell anybody. Anyway, that's a whole other story. The point is, he's back under contract. It's in foreclosure, and it's going to sell very quickly, actually. So the problem is when there's foreclosures and they just sit on the market. That would be a problem. But if you look at this graph, actually, that I'm going to put up, if you look all the way to the right, that's 2024. It starts 2028, of course, in 2010. We saw increases in foreclosures, but they've been decreasing. In 2021, they were the lowest ever because of COVID. Everybody was buying. But they have come up, definitely, which is normal. In the whole U.S., this year to date, there's been 177,000 foreclosures. Now, I know that that's a big number, but not when you talk about all the listings in the U.S. This is a U.S. graph, okay? If you look at, I've got another graph for you just to kind of look at it a different way, but foreclosures represent currently in May 2% of our market. 2%. That means 98% of the homes are just selling pretty normal. So for those of you that think that foreclosures are going to crash our market, I would love to know what data you're looking at. I do. I love to study this. I'd love to do another live about it. I want to bring info to y'all that is real facts, no BS. I'm like not making this stuff up. I want to use data so that we can make good decisions and know exactly what's happening. I don't know. I something drastic would have to happen, and it could. You just never know. Something drastic would have to happen for everything to just stop and foreclosures to be everywhere. And I hope that doesn't happen, because that means that a lot of other bad things are happening. So let's talk about the other elephant in the room. I get this question a lot. Oh, well, the elections are coming. The rates they're going to go down because the politicians want everything to look good. So I'm going to let you in on a secret. The politicians don't control the mortgage rates, nor does the Fed, by the way. So you might not know this, but the Federal Reserve is not a government-owned entity. They're actually a private company, and they are there, and they were created way back when to keep the government in check. So they are the government's closest advisor. What they talk about on the rates are the rates for, it's called the federal funds rate. And that's the rate at which banks borrow money overnight. Banks have to borrow money from the government in order to cover their deposits and their loans and things that happened overnight. Literally, it's their emergency lending rate. But they heavily influence what's going on. Okay, so they're not directly related though, but it is kind of a trickle down. So that being said, it's interesting. I thought this was interesting data that after the last 11 elections, if you look at this little chart that I've got here, after the last 11 elections, there was only twice that home prices didn't go up, meaning supply and demand changed, right? So people usually, especially the 3 and 4 months leading up to the election, I think people definitely hold back. I have heard that a little bit where some people say, hey, I don't know what's going to happen. I just want to see what's going to happen in the election. But it's interesting to me that home price, now we're not talking about rates, we're talking about home prices, that home prices started to go up after the last elections. Now, this data is compiled on this graph from the Housing of Urban and Development and NAR, National Association of Realtors. So super interesting data. I thought that was interesting to point out. Now, there is an interest rate reduction coming. We're going to talk about that. So you want to stick around. We're going to talk about that in the affordability and rate little discussion that I have for you. So let's go into affordability first. So when will you be able to afford a home? There's a lot of people I deal with every day that say, Jennifer, I'm putting things on hold. I just cannot afford these mortgage payments. I hear you. I super get it. Let's look at your credit. Let's get you ready, because when those rates do start to come down, y'all, there's going to be a mad dash. I have this prediction, and I don't know if I'm going to be right or wrong, but I have a very strong conviction. I've done this for 29 years. I've seen many cycles. I've seen good times and I've seen bad times. And I think a lot of people are going to just be coming out of the walls like ants to come buy houses. And that's going to inflate the prices, is what I think. So affordability on rates, when will we be able to afford a home? Well, I'm hoping that it'll be soon, that we're going to start to see a trickle down of these rates so that payments can be more affordable for you. So we're going to look at these rates here in a second, and then I'm going to answer a couple of questions coming in. Hey, Ryan, thanks for checking us out. All right, so let's look at this graph here. Basically, you can see, so we start at 8%. We're not seeing much of 8% right now, but if you've got not so good credit, we actually are seeing things a little bit high. But this shows you a range from prices or monthly payments, principal and interest only. This does not include taxes and insurance. A home price of $530,000, and to the right is $450,000. So I'm going to cruise all the way to the right. In my market in Texas, $450,000 is a little bit probably more reasonable. But a house loan amount, not price, but loan amount of $450,000. If you're at 8%, that's $3,300 a month in principal and interest. If you go down to 6%, which is a 2% drop, you go to about $2,700 a month. That's a $600 a month savings. So in other words, every percent is $300 a month. Now, of course, there's different rates for different prices if you're higher or lower, et cetera. But I think you get the point that even a 1% reduction, going from 8 to 7, again, $300 a month. So there is some glimmer of hope in sight, y'all, to be able to buy into this American dream. Now, those of you that can afford the payments, you may not like it. I mean, we are closing homes. We are financing the American dream for sure. I finance people every day. They don't like the payments, but they're using seller credits to buy them down potentially. And they know that in the future, just based on data, they know that they're not going to be in that home loan for 30 years. they do know and do have a high probability that they're going to be able to refi. But what I think those people are going to be able to benefit from is they're going to benefit from appreciation, that when all those people do come out of the holding pattern to buy, the ones that did buy now are going to enjoy appreciation that they might not have had if they had waited. So the cost of potentially waiting is that you might miss out on that little appreciation wave that's going to happen. I'm waiting for that wave. I'm considering we might sell our house next year, where it's a very high probability that we might sell our house, but I'm waiting because I know that when those rates come down, that there'll be more people out in the market. So you just never know. Okay, Ryan has a question. Hey, Jen, if you had to guess, what do you foresee happening in September when the next Fed fund rates update? That's a very good question. Assuming there's finally a rate cut, how do you predict mortgage rates to respond? So the Fed met on the 31st. They just met a couple days ago. We knew that they were not going to lower rates, okay? There was like almost 100% chance that they weren't, and they didn't. Now the tables have turned, and there's almost 100% probability, based on what economists are saying, that September 18th, which is the next Fed meeting, there will be a 0.25% drop. Potentially, there could be a 0.5%. We don't know. So it's a very high, almost certain probability. Ryan, that is kind of already being priced into the market. The investors are a very fickle, it's a very fickle crowd, I will tell you. They are very easily swayed and very easily excited. Okay, so they know that this is happening. So we're starting to see that reflected in the market right now. Now, in the next 45 days until the Fed meets, of course, anything can happen. Other things that affect interest rates, global things, there could be a global collapse, there could be a bank failure, lots of different things could affect those rates between now and then. To answer your question, I think a lot of it is already priced in because we've already seen some reductions, trickle. The thing that would move the rates either way is if there's a surprise. So if they don't do a quarter and they do a half, for example, the mortgage rates would go down almost immediately like that. They would be like, oh my God. It's not percent for percent. So just because the Fed decreases 1% does not mean that ours will decrease 1%. Sometimes ours decrease more. I've seen large decreases, large meaning like 0.5%, for just something happening. The things that benefit interest rates is usually bad economic news. That usually actually favors interest rates, believe it or not. So it remains to be seen. But what I will say, keep watching the channel. I'm going live every Thursday now. So my goal is to bring you real facts, no BS about everything mortgage. In fact, next week, we're talking about land loans. I get a lot of calls about lots. I want to buy a lot and I want to build my dream home. I don't want to deal with these builders. I don't want to deal with resale. So there's a lot of people that want to do that. So you want to tune in because we're going to be talking to a banker, a friend of mine who's a banker. We're going to be talking about lot loans, land loans. So I definitely want your questions. In fact, send me your questions now and I'll go over them, make sure to go over them on the live. So thanks for tuning in. We'll see you next time. See you next Thursday.